That's good. Well, let's find out. Let's find someone who knows more about flow of funds and flow of life than pretty much anybody I know. We've got Larry Fink here, which is really pure joy. He's the CEO of BlackRock, which is an amazing company with $9 trillion. And that's just an incredible number.
Thank you,
Larry,
guys.
I think you share, because you say it in your statement, optimism is what's pervading your documents today.
Yeah, I think our quarter really was a continuation of the last 5 years. Last 5 years, we grew by $1.8 trillion in net inflows. We actually grew more in this first quarter than the first quarter of 2022, about $110 billion of flows. Clients are responding to the changes. I mean, we talk about all this pessimism, but the reality is, for long-term investors, buying bonds, buying interest rates at 5-6%, before a couple of years ago was 1%, you can actually earn a high percentage of your needed return to meet your pension fund liability. And that's just being missed. And so we're seeing more and more clients who are looking at bringing down their risk, but keeping their portfolio much more holistic and a little more resilient by having a better foundation of bonds and equities. And that's what's happening right now, and we're seeing that.
We wiped out a class for a while. Short term. We wiped out short term, but it's back.
We wiped out bonds for years, and this is one of my fears. Over the last 10 years, the number one trade that people made money on was shorting liquidity. Right. I don't believe that's going to be the next great trade for the next 10 years, and shorting liquidity means you got out of bonds and bought more privates, and that trade worked. The question is that going to work now in the next 10 years? And, when you see interest rates that in the credit space, in the intermediate place, earning 5 and 6%, that really is allowing you to take on a lot more fixed income as a part of your portfolio. You're actually de-risking, but you're able to get your necessary returns through that mixture.
Well, before I cede it to my colleagues, it does sound like that what happened mid-March accelerated a Darwinian move in banks where we have the larger get even larger,
right,
and made it so that we realized we didn't need to earn 2%. If we just called Larry Fink, we could pick up 5%.
Well, I think what happened in 2022, banks did not raise their deposits as fast as the Federal Reserve was raising rates. And the money market funds continue to adjust the rates every 30 days, essentially, as their maturities are much shorter. And so you saw this giant arbitrage between what money market fund rates are or short-term bonds are versus deposits. And then you started having impairment with some of these banks related to their held-to-maturity account, and that just precipitated a real reimagining how you're going to manage your portfolio. And so we saw a lot of people move their portfolios out of the smaller banks that had yields that were much lower into the larger banks, as we saw today in some of the earnings, and into the money market funds. We've seen over $500 billion of money leaving the banking system into the capital markets. And that's one of the pervasive things I talked about today. I talked about in my CEO letter, that we're seeing a acceleration of movement out of the banking system into the capital markets. And that continues on. You could ask the question, is that good or bad? We could all raise those questions. The large banks are benefiting from this. The large market-making banks are benefiting it, and the capital markets are benefiting from this. And that's going to be a big societal question. How do we want to navigate this? We still have 4,400 banks. Is that the proper size? Can they perform in this type of atmosphere, especially as we move towards digitization of currency? How we change payments? And then the bigger, more existential issue, and I believe, as we were talking about earlier, I believe interest rates are going to be higher for longer.
So you're in the Jamie Dimon camp, because he said the same thing this morning. Okay,
I believe that, as I said in my CEO letter a few weeks back, I believe inflation is going to be stickier for longer. In other words, I think we're going to have a 4-ish% floor in inflation. I think the numbers today kind of reconfirmed that. The market got ebullient over a 5% print down from 6%, but that still plays into what I think is going to happen. And I think a lot of it has to do with geopolitical issues. We have moved away from this whole concept of globalization.